Hey, welcome back, subscribers, to my world of stocks. Now, as you guys know, BlackRock is, of course, the largest asset manager in the entire world, with their largest stock holdings really being some of the biggest tech giants in existence, like Nvidia, Microsoft, Amazon, Google, Meta, and more, all of which have huge exposure to artificial intelligence, which is also one of the biggest reasons why each one of them is also worth trillions of dollars in market caps. Well, for today's video, rather than looking at those same Mag 7 type of stocks that BlackRock is seemingly always buying, instead, I pulled out three AI stocks that are still very large, but are smaller in comparison, couple hundred billion in market cap each. And they're ones that BlackRock is also buying very aggressively right now. They spent over $1 billion on just these three stocks last quarter alone. So we're going to take a look at why BlackRock is buying them so aggressively. I'll give you my own opinion on each one of them. And most importantly, this is a fun part. I'm also going to let you know how likely I think it is for any of these three AI stocks to actually break north of $1 trillion market cap too, like their, big tech giant older brothers, over the next 10 years. So over the next 10 years, can any of these break $1 trillion? I'll give you my opinion on it. I'll give you a percentage on it. So I think that makes this a much funner type of video. I've never done this before. I don't know how it's going to go. I hope you like it, but smash that like button if you do. Let's just go ahead and jump straight into this list here, my friends. All right, and first up here, we'll start with the smallest of the bunch. We have Lam Research, ticker symbol LRCX, which it's BlackRock's 46th largest holding. I made sure all three of these are still in their top 50 for relevance and other reasons. But last quarter, they purchased another $238 million worth of the stock just in a single quarter alone, which brought their total stake up now to more than $16.5 billion. And at the moment, Lam carries a market cap of less than 200 billion, meaning they would have to more than 5x in size to reach $1 trillion in 10 years. Okay, well, when looking at artificial intelligence, it's of course, chips, the semiconductors that act as basically the building blocks of all AI and modern technology. Without that, wouldn't really have the capabilities to process the insanely large amounts of data required to fuel AI, making it arguably the most important component for it, right? Well, in order to increase performance and efficiency, these silicon are sliced into thin wafers that contain countless of microscopic circuits and transistors within them, sometimes in the trillions. So you can imagine just how insanely complex the actual manufacturing of these chips would be. Well, Lam Research just happens to specialize in making the actual equipment that is used for semiconductor production. And while the company's history dates all the way back to the 1980s, it's really this new massive wave of AI hype that has gotten investors much more interested in a stock like this, and likely why BlackRock is buying heavily now too, resulting in the stock soaring by over 200% in the past 5 years and closer to 2,000% in the past decade. Now, unfortunately though, that has left the valuation a bit more expensive than usual, with a forward PE that is about 37% higher than the sector median, although their PEG ratio that factors in future growth is much better at about the same as the sector, while also being 21% lower than their own 5-year average, thanks to the AI boom resulting in larger sales and profits, more importantly, that are expected in the coming years, where demand has been exploding for semiconductors, with both organizations and governments around the world trying to get their hands on as many of these chips as possible to power AI applications. And that's, of course, fueling demand for a company like Lam Research that supplies that equipment. In fact, Nvidia, for example, said recently that AI infrastructure spending alone could reach as much as $4 trillion by 2030, an absolutely gigantic figure. And well, if that turns out to be the case, then Lam could also be a huge beneficiary of that spending, as companies are forced to buy more of their equipment to produce more chips and even pay for new upgrades, as well as recurring support services that Lam provides for them too. As such, analysts are projecting surging double-digit growth on both the top and bottom line while breaking new record highs. Given all that strength and dominance, I can absolutely understand why a giant like BlackRock or even smaller retail investors like yourself may be wanting to own a stock like this. But for me personally, the recent run up in price is just too much to bear considering I already own so many other AI and chip related stocks as it is, including, by the way, one that is somewhat similar in ASML, who I just bought earlier this year on a big dip. Now, all of which leaves me with, I would say, without much desire to pick up another stock that is similar like this. But do I think that it can still reach $1 trillion market cap over the next decade? Well, like I said before, it would have to more than 5x in size from here, which I suppose is possible. And we've certainly seen it happen before too. And if AI infrastructure continues to ramp up even more in the future with all kinds of new AI technologies getting heavily integrated into most of the things we do out there, which I think will eventually happen, then sure, there's no reason why a company like this couldn't eventually 5x in size if they're one of the biggest suppliers of that crucial and necessary equipment. Although I believe Applied Materials and Tokyo Electron are still larger rivals. Regardless, though, at this current moment, my gut still tells me that 10 years just won't be enough time to really ramp up the necessary growth that a hardware company like this would need to reach such a giant milestone, especially after how much the stock has already risen more recently, which brings up what I think would be the biggest hurdle of all, and that's that semiconductor equipment tends to be pretty cyclical, where downturns can sometimes even cut into the company's sales and profits by huge amounts in a single year. Last year, for example, Lam saw declines to both their sales and their profits in the double digits. And to make matters worse, you have to remember too that equipment makers have historically traded at much lower multiples than fabless chip designers like Nvidia or AMD. So the hill is a little higher, maybe a little harder for them to climb than some of their perceived peers in the same kind of space. And so as a percentage, I'd probably give it like a 20% chance at best, maybe 25 if I'm being really generous, but I just think that there's better and even cheaper AI plays out there at the moment. But again, that doesn't mean that this stock can't still perform well during that time. I actually think it's a pretty decent one, but reaching a trillion so soon does just feel like a bit of a stretch. But let me know if you disagree down below. I'd love to hear your thoughts. All right, moving on to purchase number 2 though. So here we have an even larger purchase of close to $700 million in the quarter, bringing their stake up to around $17.7 billion worth, and that is in ServiceNow, ticker symbol NOW, which currently holds a market cap of also just under $200 billion and would need to grow nearly 6 times larger in order to reach $1 trillion market cap. Now, this one's definitely an interesting pick here because it is a cloud specialist, which we know just how important and crucial really the cloud market has become, especially for facilitating the use of AI. Well, ServiceNow is a company that offers cloud-based AI platforms for enterprise solutions, helping companies organize much of their business and their work patterns into better structured digital workflows that improve efficiencies. For example, they make it easier to delegate tasks, support hybrid and remote workers, execute decisions faster, and even trim expenses. And more recently, their newest AI integrations have boosted each of these services much further with all kinds of automation tools and apps, including chatbots and even virtual agents too, that together enhance the entire experience. The result being that even during a challenging macro environment, ServiceNow continues to see rising demand because of how beneficial their tools and services are in helping these companies run leaner and more efficiently, which is even more crucial during challenging times. A case in point, over the past 2 years, Now's number of customers spending over $5 million per year has actually grown by close to 200 accounts, which is a staggering amount. And just as impressive are their retention rates, customer renewals consistently hovering well above 90%, closer to 100% really, while those same customers also increase their spending by huge amounts over time too. In other words, Now's products and services are so effective that customers keep coming back for more, resulting in a very sticky business long term. And of course, when the economy is actually strong, companies will have even larger budgets to hire a company like this to help them grow even larger and stronger, which I think is probably the biggest bull catalyst that investors will have in a stock like this ever reaching $1 trillion market cap. It's a pretty good one, I'll admit, considering that the Fed is expected to lower rates in the coming years, which is usually a tailwind for business growth. And while the stock is technically still up a huge amount already over the past decade, I do think that this recent dip that we've been seeing here, where it's lost more than a fifth of its value so far this year, could potentially act as a jump board for a bigger rally long term if they can gain some momentum, especially financially, where the company has only recently started prioritizing the bottom line more aggressively, going from less than $1 of EPS in 2020 to more than $8 in 2023 to more than $17 expected this year, and then more than 20 expected next year too. That's incredible growth that, if maintained, doesn't have to be perfect. Mind you, there can be some challenging periods along the way, but if the overall trajectory remains the same like this, I think it's very plausible that the stock does break a trillion in 10 years. The biggest reasons being, again, very high growth sector where they operate essentially at the intersection of cloud, digital transformation, and enterprise AI, all of which are massive high growth markets. Got to ramp up in AI monetization, making them even more profitable on higher margins. And overall, just the fact that they operate in such a scalable, high margin market that should provide the growth opportunities that one would need to reach such a massive goal like this. Now, the only issues that give me pause, though, are rising competition and an already pretty rich valuation, where I fear some of this growth may have already been priced in. On the competition side, for example, you've got anywhere from massive behemoths like Microsoft to even smaller but still very large and growing tech monsters like Oracle, Salesforce, and more. Not to mention that even other AI giants like Palantir, while not currently being considered a direct competitor, could one day become a bigger threat as they grow and expand their services into new verticals too, maybe sometimes overlapping a bit. And if that's not enough to worry investors, the valuation on a forward PE basis is currently sitting about 100% higher than the sector, non-GAAP, and over 200% higher on a GAAP basis too. Now, that does improve on PEG because of that strong growth that I showed you earlier, but it's still about 15% higher there too. And so overall, I do think that this one has a much stronger chance than Lam Research, but I'd still cap it at around 30% overall, just because it's never easy to have, a 6x run up in size when you just had already a monumental surge in the stock price. But I think 30% is pretty fair overall. But because so many of my largest holdings are already very similar to ServiceNow, including Microsoft, Palantir, and more, I probably won't be picking this one up myself unless we see a bigger dip. But it's a pretty good stock, though. I do like it a lot. And again, I give it a higher chance than Lam Research. All right. Now, while I don't currently own either of those first two stocks myself, purchase number 3 is actually a personal holding of mine. And this one is in Cisco, ticker symbol CSCO, who BlackRock purchased close to $450 million worth during the quarter, bringing their stake up to more than $25 billion in total, making it their 28th largest holding overall. And on market cap, this is a stock currently worth around $300 billion at the moment, meaning it would have to more than triple in size to reach $1 trillion, which is actually the smallest amount needed of the 3. Now, you might think that I would clearly choose this one right over the others, given that I actually own this stock myself, but you might be surprised because even though I do love their business, they just don't carry the same explosive growth potential that a stock like ServiceNow does, that I feel is required to reach such a large milestone. In my opinion, Cisco is a lot safer, but it's more of a slow and steady wins the race type of stock. It's a mature, high cash flow company with moderate growth expectations and a stock that will likely deliver stable, compounding returns that are supplemented by its dividend. Case in point, despite the stock breaking new record highs, it's still only up around 180% in the past 10 years, which is, don't get me wrong, is good performance, but it's much lower than the other two. And most of those gains also occurred just in this past year. However, It's also a better value play, as they're the only one on the list that actually trades cheaper than the sector on a PE basis. And while the dividend is a little low right now at just around 2% because of the recent run up in stock price, I actually bought Cisco more than a year ago before that when the price was much lower, leaving me with not just a lower cost basis, but in turn also a much higher dividend yield of more than 3.5%, which is pretty good considering the low payout ratio and double digit growth history that suggests it'll continue getting larger over time. I also think that the business will continue growing stronger as they transition away from being just a legacy hardware seller of various routers and switches to now being a much higher margin software company too within AI, cloud, and even cybersecurity, all of which are boosted further by their acquisition of Splunk, which is one of the biggest reasons why I bought the stock myself too. I really love that acquisition. Now, all of these moves are already paying off for Cisco as their financials are expected to continue breaking new highs, especially on the bottom line as margins improve from new software revenues. But I still think that overall growth is going to mostly keep hovering around the mid to high single digits in most years, with 2027, for example, expected to see around 5% revenue growth and 8% EPS growth. Now, at those levels, I'm just not sure Cisco will be growing at a high enough clip to warrant a $1 trillion market cap in just 10 years. It could definitely happen. Don't get me wrong. I've seen stranger things happen, in the market. I'm sure you have too. And really, all of these stocks that we've talked about could theoretically reach those levels. But I just think it would take flawless execution from management, really favorable market conditions, and probably a couple surprise hits either in new product launches or new acquisitions, just something to give them another edge. But as it stands, I just really think ServiceNow for sure has the highest chance among these of reaching a trillion market cap given their higher growth in a great sector with strong customer renewals. Then I'd put Cisco at number 2 with about a 25% chance because of their larger size and overall strength, requiring the least multiple of growth to reach a trillion, while also being a bit of a safer bet than Lamb, in my opinion. And then finally, I would put Lamb at number 3, who, although is operating in an excellent growth sector too, of AI infrastructure, I just worry that they'll be too sensitive to chip cycles, adding an element of uncertainty. And you have to consider that the market has historically, again, valued hardware companies like this a bit lower too. So I'd cap them at around a 20% chance of reaching that trillion. But hey, that's just my opinion. What do you guys think? Do you agree with my assessment? I'd love to hear from you down below. I admit it was a little hard to give an opinion on something like this. It can definitely be subjective in certain areas, but either way, I just hope that you enjoyed the video. And I thank you so much for stopping by, my friends. I hope you're all doing well out there. And I got more videos coming for you soon. So stay tuned. Catch you in the next one. Take care, everybody. Bye-bye.